This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of the show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Interested in learning more about investing in startups, launching a new startup and need to raise funding? The Startup Funding Espresso is a daily podcast in a short, concise format delivered to your inbox every day, Monday through Friday. In the time it takes to drink an espresso, you can learn about startup funding. To subscribe, go to investorconnect.org and put your email into the pop-up box. Well, hello, this is Hall Martin with Investor Connect. Today we're here with David Blackledge, angel investor, professor at Grand Canyon University, and attorney at Davis Miles Law Firm. David, thank you for joining us.
Thanks for having me, Hall.
Great. So what was your background before you started investing in early stage companies?
Well, I spent over 30 years with startup technology businesses in sales and operations management, and then candidly took a flyer and went back to law school. So I was in business, basically helping to raise money and asking for money. And then I became attorney, and I specialize now in helping people conduct fundraising. So I went to Arizona State, started law school well into my 50s, and became an attorney about 10 years ago.
Great. So tell us more about your angel network, the Grand Canyon University.
So Grand Canyon University is relatively new. It's about 4 years old. We've invested actually several $1 million in businesses so far. But prior to that, I've spent more than 10 years in angel networks with membership in places like Arizona Tech Investors in Scottsdale and Desert Angels in Tucson, Arizona. From that too, of course, we syndicated a lot of deals, so I got to know other angel groups as well, but primarily the angel groups based here in Arizona. And regarding Canyon Angels at Grand Canyon University, I'm a founding board member of that.
Great. So let's talk about the state of angel investing. How do you see the industry evolving for angel groups post-COVID?
So I think there's a lot of things that carry forward still. I think that angel groups over the years had become, the two things have happened, I think, Hall. We have seen a increase in the amount of money people were requesting. Okay, so what was 5 or 10 years ago, a few $100,000, people are now asking for $1 million, $1.5 million for their seed round funding. I think that's going to continue. I don't know how big the numbers can get. I think we're probably at a logical limit for what angel investors will do, even in syndication. I think that the hybrid model is going to continue, but I see a lot of specialization now. And I think that I kind of talk to the available investor pool. So if you look at certain groups, like SaaS model companies, software as a service, it probably has the largest number of investors. However, there's a lot of specialty angel groups that are coming to fruition. A lot of people in fintech, financial tech, educational tech, education or ed tech, agricultural technology. I've made investments in ag tech before too. One of the highest tech industries around, although most people don't realize that. So I think that the circumstances and what's happened in COVID and similar circumstances have kind of driven people more to specialty markets that they understand, that they invest in. It used to be much more general in angel groups, and now I think we're becoming far more specialized.
Right. And so what do you think is the biggest change you think we'll see in angel groups in the coming years?
Well, the thing I always look at is when we look at two things. We look at the syndication, and again, if an angel group might average $300,000 to $500,000 in a company investment, if they really like the company and the investors are focused, if they want $1.5 million, they need to have a handful of angel groups to complete that investment. People don't get $1 million checks at first seed funding. Okay, so I think that that's key. So otherwise, I think we're looking at this specialization continuing, and I always see kind of a logical limit in how many members are in an angel group. And again, it's just my observation. I see about 100 people, and I'm not sure if that's a limit of people that, as they look at the deals that they're creating, that they're funding, if it becomes too broad for some investors. But it seems to be that there's almost a physical limit in the number of investors in a particular group. And again, from my experience, I see about 100 people. You never see angel groups with hundreds and hundreds of people in it. And I also see that and this may be an effect of COVID as well. It's all about deal flow in angel groups, right? Where are the quality deals? And when I look at this, I see more and more people maybe investing on their own. So angel groups are going to still be necessary, but as people invest, particularly in places like real estate, there used to be a lot of angel groups investing in real estate. You see a lot of crowdfunding there as well, but people are still focusing on investments than on their own. And I think that might be a trend as well. People might want to do their own diligence and find their own opportunities, or they hear about opportunities. So they use the angel groups as kind of a source of ideas. But moving forward, they've always invested individually, typically, but I think that's going to become more and more common as we do post-COVID kind of investing.
Great. And what do you think is the biggest challenge angel groups face today?
I think the biggest challenge is still going to be things like deal flow. Okay, where are the quality companies? So if you look at the next level up from angel groups, private equity, they may invest in fewer than 1 out of 100 deals they see during the year. So there's a lot of people that they literally take out 75% of the companies is not ready for prime time. We have this similar circumstance on a slightly different scale. But if you have an angel group that gets, say, 30 applications, they may present to 3 or 4 people. So winnowing down a large number of applications to the types of things that investors want to see within the parameters of that angel group, and get quality companies, people that are good stewards of their money. I think that's going to be key. I think entrepreneurs come to the table wanting to talk a lot about their technology, and I've mentored literally dozens and dozens of student startups, and they want to talk about the technology. And I always say, no, the first meeting, all you're trying to do is get the second meeting with investors, and they're just checking boxes. Okay, generally, the business can support investor level returns. The industry itself, it's a multi-billion-dollar industry. Okay, check that box. Does this company, does the business make sense? And they check that box. But basically, they're looking to see if the entrepreneurs are going to be good stewards of money. So the phrase we like to use, Paul, is we're betting on jockeys, not horses. Okay, a great manager can push an average business over the finish line and get investor level returns. And I think that understanding comes through things like, if those people were not funding, maybe get them to incubators and accelerators where they learn basically the fundamentals of how to present their business, but basically too how to run their business. So I think that's a big challenge. It's always been about deal flow. And I think that continuing, it's going to be about finding those deals that'll give investor level returns for people, or at least have a good chance of doing so.
Great. So what's your group's investment thesis? What exactly are you looking for in startups, and what's your criteria?
We're looking at early stage businesses, of course. We really look at the diligence that the students are doing at Grand Canyon University through the Canyon Angels. We're looking at business plan, and we're looking at rational forecasting. Okay. So I think that the overall thesis for it is getting within our investment parameters. And by that, I mean, we're primarily looking at, I think, software companies. Again, there's other specialty businesses that do things in with specialty angel investors, but I think the majority of the angel groups, I think now in our investment thesis is we're looking at people that can produce recurring revenue. I think that's a big thesis for us. Okay, so we always want to look too at the market generally. And again, we hear this, and it's counterintuitive. I think we hear people say we're unique. There's no one else doing this. That actually scares investors and scares our group as well as anyone else. We never want to be the first one in a market, and we never want to be the only one investing in a market. And that's because, and it's I think it's correct still. If it's a great business idea, why aren't 100 other companies trying to do the same thing right now? So we never want to be alone. So we look at those kind of things too. We don't mind extensions to a current industry or a current product line or a current investment opportunity. But when people come in and say that no one else on earth has thought of this, it's one of our parameters that we go, that's kind of a red flag, right? Why isn't a lot of smart money trying to solve this problem? So, I often joke that, we don't want to have solutions desperately seeking out problems. It's the other way around. We want to be able to have a problem that exists and it's well known, and then a company tries to solve it. So I think those are the basics I think that we're looking at for our investments.
Great. Can you mention one or two portfolio companies that fit that thesis?
Well, one of my personal investments was Myland. It's a ag tech company, agricultural technology company. And a worldwide problem is decertifying soil. China, for instance, loses something like a couple million acres of arable land a year because they're over farming. And that's how the Dust Bowl occurred in America. We over farmed it. There was no regulation of farming, and the soil basically died. So Myland produces a super algae with a patented technology that can actually recertify soil that had been basically decertified. It was not arable anymore, and they can make it work again. So that to me was impressive in the technology, but the social need to be able to recertify soil that had been overused, I think is a huge market, and it's absolutely a worldwide problem. There are dozens of countries around the world that had basically ruined their industry because they just simply are letting people out. We see this in America. You look at the cod industry outside of Massachusetts. It literally died through overfishing. So the government stepped in, put in licensing, and put in limits of catch, and restocked the fishing industry. And now everyone's that's there that with the licenses making good money. So you have to have some government regulation in these things. But basically, you have to have also the technology to perhaps correct problems that existed before. And Myland, I think, is doing that well. But they're getting money now at a fairly significant valuation. And that's one industry that I invested in personally.
Great. And so does your group have a fund?
What we do, we don't have a fund as such. We run as an angel group, which means we present businesses to people to invest as they will. But we also do sidecars, which has automatic triggers. And the theory there is, of course, if there's a group of experts in a particular industry, Desert Angels is big about this. There's a lot of life sciences and biosciences people in Tucson from the University of Arizona, and they understand it. And so the theory is if a number of experts in that world have invested, it's kind of good enough for the rest of us who don't necessarily understand that particular industry. That's one example, is that particular fund. And then we also do single purpose LLCs, like a lot of other angel groups. If if people want to have a minimum of say $50,000 or $100,000 as an investment, and you have a number of small investors, we'll collect those into a single purpose LLC and give the company a check for $100,000 or $200,000, which combined a number of angel investors' money.
Great. So what excites you right now?
What I'm seeing a lot of, there's a lot of focus on socially conscious businesses, okay? Conscious capitalism. So doing well by doing good. People that are setting up incubators and accelerators. I'm a longtime mentor of SeedSpot. It's now a national organization. They're, I think, #1 socially conscious incubator ranked in the country. I see a lot of that, and I see a lot of people, young people, that do the vast majority of business formation. I see them as coming up with a lot of ideas that are profitable, but can help society, help a lot of the problems, like the Myland investment, recertifying soil. There's a lot of opportunity out there, financial technology, education technology. I see one example, you see the ads on television. People can buy fractional shares with new financial startups for as little as $5.
Wow.
The idea of fractional shares didn't exist even 5 years ago, and all the big companies now are starting to copy them. They're having funds that copy what the startups are doing. So it's kind of the big guys are realizing if you can get customers early in their investing career and allow them to invest, you get to keep them for a long time as long as you take care of them properly. So that's one example of exciting new occurrences in an industry, financial technology. We stopped the regulation of financial stock sales and the commission rates, 35, 40 years ago, right? That all went away, and things had kind of moved forward and hadn't changed much. But here's a bunch of startups changing the marketplace. You see this in real estate as well. A lot of people having startups in real estate that are allowing people to basically get involved in real estate. And that's where most people in America had made their money. So there's a lot of changes like that. And I consider them to be what I would call, and a lot of people have called, conscious capitalism. Imagine that, people that couldn't invest at all before. And now you have kids in college, a lot of my students, they're putting in $5 or $10 a month into fractional shares of businesses. If you start people that young doing it, I think it's a wonderful thing for our economy.
Great. So what's your advice for people investing in startups? What do you tell them to do before they write that check?
It all comes down to the diligence, okay? They have to have a number. They almost have to have a questionnaire for the companies they're talking to. And they want to talk to advisors and experts in those fields of study as well. Again, I think that's why people tend to think about themselves as maybe liking software, because everyone uses software, but it's not that easy. I think that people have to be aware that the angel investing, 5 or 6 out of 10 times you lose everything. You lose your entire investment. 2 or 3 out of those 10 times, you get your money back. So you put in 10,000, you might get 10,000 back. 1 out of 10 times, you make a decent return on your money. So you have to be aware of that, and you have to have in your portfolio, you have to understand that those losses are not unique. They're actually average. So you win 1 out of 10 times, you're in the angel investing Hall of Fame, right? So I think that's one. I think you have to be able to do the diligence on the market itself. Is this a real problem? Does it exist? And are people willing to pay to solve the problem? And are they willing to pay that much? Okay. So there's a lot of people trying to get users on freemium models. You give it away, but you have to basically price up if you want to have the enhanced versions of that. And you have to know the metrics of the industry. Okay, if you're looking at software, for instance, how many users have downloaded your software, this company's software, rather, as an investor, you're looking at that. Of all the downloads, how many people are using it? How often are they using it? How many minutes a day are they on the software? What's the churn rate? How many people have deleted? And you can tell how many people have deleted your software. So you look at all these metrics of the industry you're looking at, and it becomes pretty clear who's being successful and who's not. So
Great. And then on the other side of the table, what's your advice for people running startups? What do you tell them to do before they go out to raise funding?
they need to have focus. I see a lot of entrepreneurs come in and talk about, we have 6 different revenue streams. No, we're counterintuitive. We want to have your best revenue stream for the next 12 to 15 months that we're funding. We're actually worried if you're looking at half a dozen different revenue streams, a few people, a handful of people can't possibly make that successful. So we hear a lot from people talk about how great their business is going to be. I think that they are unaware that hockey stick sales projections and revenue projections actually scare us. We want to have the most conservative numbers. And I as a curmudgeon now, people present me outrageous forecast numbers. And I ask the question, so if you miss your forecast in any of the following quarters coming up, I get to fire you, right? And they go, oh, let me go back and revise these forecasts, right? And they kind of get some real serious about that. But they also need to understand these skill sets they don't possess. So if you have a team of engineers and you've made a great product, it's great to see, and I've seen this just in the past week, someone say, I'm not a numbers guy. I need to have at least a part-time numbers guy, and they're a fractional CFO, for instance. I don't know how to do sales and marketing. I need to have that. And they budgeted for it. I consider that very mature. And I've actually talked to someone in the past month that said, I know I'm not a CEO. I don't have the stomach for it. I know I'm the idea person. However, I'm not going to be able to run the business. So if an investor comes in and says, we want to put in a board member and we probably want to replace you as a CEO, they would actually welcome that because they know that they don't have that skill set. And it would probably just take too long to develop that. Okay. I also think that people don't understand the amount of time it takes to truly scale a business well, to grow the business properly to a point of where they can say, we can now handle the next level of users. So to go from 1,000 to 10,000 users in your software, and then to go to 100,000 users, that may take an entirely different team of people and a need for different skill sets. It's good to see people that understand that. But those are the common things I see with entrepreneurs that they should understand before they ask people for money. And looking at those counterintuitive things, and I actually have published, I don't know if I've told you, I published my fundraising 101. And it's not me being smart. It's just after a dozen years and looking at 1,500 pitches, I looked at people who got the money, who didn't get money, and what did each side do to have them investors walk away or have investors write checks. And there's just a number of commonalities. And I think those are the types of things, people that understand their business, they understand their lingo of the business, they understand the marketing challenges, and they understand the skill sets that they need. So there was a person doing a nutritional product, and they were wondering what skill set they should have in their business. The University of Arizona and Arizona State have incredible talents in healthcare and nutrition departments. they should be speaking to and trying to get an advisor in that group. And they did. So it's great to be able to make suggestions to company entrepreneurs and have them go, oh, that's a really good idea. I'm going to investigate that. So those are the types of things we look for in the business side.
Great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
Well, I think that, again, people need to understand the risks of angel investments. You never want to bet, and this is why we have accredited investors, where people that have $1 million and more investable cash, and unaccredited investors. I think they should look at their risk assessment and see what risk that they can stand. For instance, investing in real estate usually is safer than investing in software startups, things like that. Mm-hmm. So people should look at their own personal risk analysis and how much money they can afford to potentially lose before they jump into angel investing. But they're going to be welcome. It's a very inclusive set of people. They're very approachable. And the more knowledge that people can gain before they actually start writing checks, the far better off they're going to be.
Great. Appreciate you joining us today. So how best for listeners to get back in touch with you?
The best way to do it is to send me an email, dblackledge1@cox.net, or if they're looking for advice or legal support or funding support, just dblackledge@davismiles.com. And I check those emails constantly, and I'd be happy to respond to anyone who has further questions or wants to have a discussion, consultation of what their business is about or what they should be doing.
Great. We'll include those in the show notes. Want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you. I appreciate the chance to speak with your organization today.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.